Hi, and welcome to Investing for Beginners, provided to you by CFE Finances. My name is Daniel Ellis, and I, along with Carlton Ellis, will be your instructors for the remainder of this course. So let's get right into it. First, I want to give you an overview of this course and what you should expect to get out of it. This course is designed for beginners and is assumed that you have no prior knowledge of what the stock market is. It is also designed to help you get your feet off the ground. After you have taken this course, you will have enough knowledge of the stock market to start researching stocks and understand how to make your first stock investment. Step by step, you will learn what a stock is, how to go about purchasing a stock, and also how to benchmark in order to understand how well of an investing job you are doing. This course is aimed at teaching you what the Wall Street jargon really means. Basically, there are a ton of terms out there when it comes to talking about the stock market, and there are too many to go over in one course. But I will do my best to discuss the important terms that you will see and hear most often and help you understand them. A whole video is dedicated to investing terminology, so don't worry. One of the most confusing parts of the market when you first start learning is the constant fluctuation in prices and indices. But as we go along, you will begin to understand the big picture and why the constant buying and selling of stocks every day in turn causes the market to move so rapidly. Also, we will teach you how to use the market to suit your individual investing goals. Everyone handles their investments in their own way, and we hope that you take this course only as a guide to learn about many different approaches to investing, and then develop your own style that will suit your individual investing goals. This course is not necessarily designed to make you rich, but as a way to make a much higher percentage of your money through investing. So just as an overview of what we just talked about, here is a list of questions that this course will answer. What is the stock market? This will cover what a stock is and what all the terms like the Dow, the S&P 500, and the New York Stock Exchange mean. What moves the market? Just like we discussed in the previous slide, we will go over what causes prices to go up and down. What is a brokerage account? We will go over in detail what a brokerage account is and how you actually open an account in order to be able to purchase stocks. How do you go about buying a stock? This will detail the process of finding a good company to invest in, finding a good price to buy that company's stock at, and the actual process of buying stocks through a brokerage account. How do you go about selling a stock? This will follow the same style of buying a stock. We will detail the process of selling a stock and how the price should be within the goal that you previously set. What are the taxes involved in stocks? This will answer the tough questions of paying taxes on your profits, but also writing off possible stock losses if you choose to sell a stock at a loss. And finally, we will help you set up a diversified portfolio in order to protect yourself against potential risks. Now that I've finished the overview of this course, let's get right into some interesting stuff. Whenever you do something in life, you always want to know how well of a job you are doing. So for investing, you can use the rule of 72 in order to see how well your investments are doing. It's essentially a great tool for benchmarking, and a concise definition of the rule of 72 is a financial calculation used to see how long it will take you to double your money based on what percentage of interest you are receiving. Now, when I say what percentage of interest, I mean the total interest of all your stocks. So say you're making 20% on one stock, 11% on another, and 15% on another, then take the average of all three, and that will be the total interest on your investments. Your brokerage account should tell you the individual percentages and your total interest, so you shouldn't have to worry about calculating the interest on your own. But if you would like to calculate the interest on an individual stock, then this is the formula. And when I started creating this course, someone asked me how to calculate the interest on an individual stock. And that's why I added this in here. So basically, if you wanted to figure out what the 20% was, this is what you would do. And I have a simple example right here. So say that your initial investment was you spent $1,000 buying a certain amount of shares of a company. Now, a little while, the stock has gone up. You've now made $100. So in there is now $1,100. Well, you basically take the amount it gained, which is the $100, and then your initial investment, which was $1,000. You divide those two and times it by 100, and you will get the interest on just that stock, which will be 10%. If you are confused, don't worry, I will tie this all in soon. And also, you're probably wondering at this point, what does this have to do with the rule of 72? And basically, the rule of 72 will tell you how long it will take you to double your money. So, divide the interest percentage by 72. So, if you take 72 and divide it by that 10%, then it will tell you that it will take 7.2 years to double your money. Now I'm going to put this right up on the board here. This is a whole example of basically saying you're now making 20%. So you originally invested $1,000. It's now up to $1,200. So you've made $200. You divide that by 1,000, you times by 100, you now have your 20%. Now apply the rule of 72. So 72 divided by 20 is equal to 3.6. It will only take you 3.6 years to double your money at a 20% interest rate, assuming you make 20% on that investment each year. This is a very great thing because in a very short amount of time you can double your money. So, this is a very concise example. Imagine investing $5,000 and in as little as 3 years, double it to $10,000. Now, imagine a 4% interest rate on a CD. 72 divided by 4 is equal to 18. It would take you 18 years to double your money in a CD yielding 4%. And currently, as making this video in 2013, I think the highest CD you can probably get is only 1%. So I don't even want to say how many years that will be because we all know. So as you can see, the Rule of 72 and the stock market are very powerful tools. So you can realize that even if I'm making only 10%, I'm still going to double all the money that I invested potentially in as little as 7 years as opposed to 18 to 20 to 30 years in a CD or a low yielding bond. Now that we have been enticed a little by the Rule of 72, we have to come back down to earth and we have to think about how much money do I need to start investing. Obviously, this is a tough question to answer because everyone will need a different amount of money depending on their investing goals that they set. But essentially, the point is that you do not need a lot of money in order to get started. It is a common misconception that you need thousands of dollars to invest when in reality all you need is about $500 to $1,000, and even then that amount is not necessarily needed. It also depends on your style of investing. Some people like to put a lot of money in one stock at a high risk, high reward style. Others like to disperse their money across multiple stocks in order to combat potential losses. Both of these strategies aren't necessarily easy to do, but over time you will build your shares and they will continue to increase over time. A direct stock purchase plan is another route to get started. Most companies allow you to purchase stocks directly from them each month, either at no cost or a much lower cost than what your brokerage account charges to buy shares of a company. A direct stock purchase plan allows you to contribute as much or as little money as you want each month, and that company will purchase as many stocks as it can with your money. This is also known as dollar cost averaging. Dollar cost averaging has been proven as a very effective method to investing in the stock market. Basically, Each month, the stock price will be purchased at different prices, sometimes a high price and sometimes a low price, but over time it averages out to effectively make you money on the stock market. And here is an example. Basically, say that you buy 5 shares of a company at $10 in January. The next month, the company will buy 3 shares at $15. They essentially had to buy less shares because it cost more. And then it went down and you were able to contribute 4 shares at $7 in March. But essentially over those 3 months, even though you bought it at a really high price of $15, it averages out because they bought it at 10 plus 15 plus 7, which is 32 divided by 3 is only $10. So over 3 months, you only bought the stock at an average of $10. So, like I said, dollar cost averaging is very effective and has been proven to help you outlast all the short-term fluctuations in the market.